Good morning. Welcome to Stock Market Today for Wednesday, February 10th, 2021. I am your host, Dan Russo, the Chief Market Strategist at Chaikin Analytics. You can find me on Twitter. I'm at Dan Russo _ CMT. Stock Market Today brought to you today and every day by Chaikin Analytics. Head over to chaikinanalytics.com/today. Sign up for a free email where I get a lot of the content for this show. We also give you daily stock ideas to consider upon further analysis. And that hits your inbox every trading day before the market opens. So U.S. equities were mixed on Tuesday, with the NASDAQ and the Russell 2000 setting new records, while the S&P 500 and the Dow weakened late in the day. Energy, materials, and discretionary underperformed, while REITs, industrials, and comm services led the broader tape. Treasuries were mixed. The dollar weakened on the major crosses. Gold finished up 20 basis points. Crude oil settled up 70 basis points, closing higher for a seventh consecutive session. And as we get to the desk this morning, futures are up 30 basis points after Asian markets closed higher overnight. European equities are mostly higher as well. Treasuries are slightly weaker to start the day. The dollar is mixed on the major crosses. Gold is up 20 basis points. WTI crude is following on, adding 50 basis points here this morning. And as we enter the day today, our overbought, oversold indicators within Chaikin Analytics are now at or near overbought levels for the major markets. Remember, we pulled back from overbought conditions in the face of the de-risking that was going on in light of the short squeeze activity from about a week and a half, 2 weeks ago, setting up opportunities in the early stages of last week. Now, as markets have continued to grind higher, we're now back at or near those overbought levels. From a support standpoint, not a ton has changed. Support for SPY 360 to 370, then 340 below that, and we still believe there's upside potential to 413. For the Qs, 315 is near-term support, then 300 more important support below that. IWM, same story as well. 190 to 200 is the near-term range. More important range is in the 160 to 170 area. So the trend is still up until proven otherwise. I guess the case can be made now that we're starting to get a little bit extended to the upside, especially if you look at some of the bigger leaders. Areas like small caps, take a look at micro caps, IWC. Certainly the case can be made that they're extended to the upside. So, what does that mean? It's always kind of an ebb and flow in the marketplace. What's the trend? The trend is up. Where are we within that trend? Probably closer to overbought. What does that mean? I think you can use overbought and oversold within the context of a trend to calibrate aggression levels. All right. There's always a constant state of being in the market. Not a constant state. There's always a state in the market. The key is to figure out where we are and what that means for you, your aggression levels, adding new ideas, managing risk, et cetera. What fits with your process and within the framework of your process. But the trend is up. We can make the case that some of the really strong areas of the market, or what have been strong areas of the market, are now somewhat extended within the context of that uptrend. So we'll continue to identify the trends, lay out the roadmap, and try to identify as best we can with a probabilistic approach, where are we within the context of the trend. Let's hit our market in a minute now. What are we writing about today? Well, some stalling action as stocks reach overbought levels. Kind of hit on that. Home construction, kind of interesting. Home construction was one of those leading areas in the market coming out of the COVID bottom. And then it went into that consolidation in the August-September timeframe, similar to a lot of the big tech leaders and the consumer-facing tech names. But now it appears, or could be, resolving to the upside. Interestingly, as markets are extended to the upside, we did not get a lower low in Treasuries yet. I stress yet because it could still play out, but in the near term, that's something we want to pay attention to. Sentiment relatively flat on the week, and as I said, futures point to a higher open here today. Looking at the major indices, you can see the mixed picture. Dow, let's call it flat, up 1 basis point on the day, 10 to 4 bulls to bears there. S&P 500 down 5 basis points, 163 to 44 bulls to bears. NASDAQ down small, down 2 bips, 28 to 9 bulls to bears there. Small caps outperform once again, 822 to 53 bulls to bears on the ratio. Bond slight uptick. According to the Chaikin Power Bar, small cap stocks and large cap stocks are still strongly bullish. Major indices across the board are mixed. Let's take a look at our stock of the day now, speaking of home construction, and we'll take a look at the home construction ETF a little bit later on in the show. But, if we think about emerging leadership within the market and then drilling down to the stock level, you can take a fund like ITB, look at its holdings, identify the names that are bullish, and see what's actually playing out. And what's taking place now is DHI, DR Horton, down 1.4% yesterday, has a bullish rating. Trend is strong as it trades above the rising long-term trend line, and the industry group, household durables, is strong. And you can see this consolidation here, and we'll look at it in depth a little bit later on. But this kind of nice rally off the lows, consolidation, and now the potential for a resolution to the upside. While that's playing out, we're seeing relative strength begin to turn higher once again, beginning to ever so slightly outperform. Now, is anything guaranteed? Of course not. Similar dynamic played out in the November-December timeframe, and it proved to be short-lived. I would say the difference there was that money flow was still bearish. Take a look at money flow now. Money flow has turned bullish. Same time, during this shift higher in November, we were overbought. Now we're rounding out of an oversold condition. So what do we have? We have a bullish fund that's beginning to outperform, rounding out of an oversold condition as money flow shifts back to a bullish regime. That's interesting to me. That certainly warrants some attention and potentially looking into it further. So for those who are potentially looking for ideas or looking for areas that are emerging as leadership, I would say do some work on home construction and drill down on some of the names in that group like DR Horton. Taking a look at the sector tracker now, movement of the major sectors over the last 5 days of trading. Not a ton changed from yesterday. Still have a fairly compelling looking board. Energy financials, cyclical areas of the market is holding strong. Comms are secular. Industrials are more cyclical. Everything green. So that obviously speaks to breadth and just kind of participation within the marketplace. The question is, where's the relative outperformance / underperformance? And you can see tech is in the middle of the road along with materials. REITs and utilities towards the bottom of the list. That's an encouraging data point. If you're bullish on the market, to see, those two bond proxy areas of the market, those kind of quote unquote haven sectors underperforming, but while still being up. I think that's an important distinction as well. Everything is up over the past 5 days of trading from a sector standpoint. So I think you have the right kind of leadership. I think there's a message that can be drawn out from the leadership dynamics in the market here in the near term. Speaking of financials, our industry in focus, insurance services. Remember, a lot of people think of financials, they think of banks, but insurance is certainly part of the financials group as well. And over the past 6 months, it's been an inline performer, actually a slight underperformer, lagging the S&P by 95 basis points. However, we have a solid power bar ratio here, 29-1 bulls to bears, and it's currently ranked number 5 of 21 subsectors, having moved up 3 slots over the past week. So some names there that may warrant some attention. Genworth, GNW, Old Republic, ORI, and Arch Capital, ACGL. All 3 stocks have very bullish Chaikin power gauge ratings and are holdings of a fund that certainly not trading above its 52-week highs. Consolidating here after a rally and, potentially on the verge of a breakout. I don't know. We'll see how it plays out. But, you have this consolidation here. And at the very least, we can say we're trading towards the top end of that consolidation. Now, you can see the kind of the inline to slight underperformance over the past 6 months, but moving in the right direction. Overbought, oversold indicator higher in the middle of the range. Money flow, let's call it mixed. So the group itself, the fund itself, is middling at best, right? You can see the neutral ETF power gauge rating. Trend is strong above the rising trend line, but there's enough of a mixed picture here. I think that if you're looking at the insurance group, this is a situation where you have to drill down to the individual names. Now, taking a look at what's trending, yesterday's S&P 500 movers and shakers are gainers and losers. A lot of this is earnings related, especially on the loser side of the board. But let's HBI up 24%, nearly 25% following their earnings and their guidance. IT, that's Gartner, bullish stock up 9.3% following their print. Northrop LifeLock, NLOK, up 7%. Nothing company specific there. Anthem, ANTM, 3.8%. Didn't see anything company specific to drive trading in that name. Same goes for DXC, up 3.75%. Bullish rating here. No news that I could uncover in my early work here today. On the loser side of the board, FTI is actually, after kind of selling one of their businesses, is leaving the S&P 500. So that stock down 6.7%. CARR. Earnings take that stock lower by a little over 6%. Take Two, same story, a little over 6% to the downside following their print. Fox A loses 6% on the heels of their announcement, and Jack Henry, JKHY, down 5.5% after reporting earnings. Still busy calendar as it relates to earnings. We've talked a lot about earnings. I've written about earnings in several of my notes. Companies are beating, and we're on track potentially for earnings growth in the fourth quarter, when, kind of at the start of the quarter, we were looking for declines, or not we, but analysts, bottoms up estimates were looking for earnings declines for the S&P 500. We're now potentially on pace for earnings growth. At the same time, earnings has, generally speaking, if we're going to sum it up, has been a sell the news event. It improved a little bit over the course of the past week, at least according to the updates that I read from FactSet. But still a sell the news event. So we'll see how that plays out. Let's dive into the charts now. It's Wednesday. We do sentiment on Wednesdays. Not much new on the sentiment front. Really, this chart at this point should be basically ingrained in your memory. The CBOE equity options put call ratio still very much in an excess greed position, as it has been since the May-June timeframe. Relatively flat over the past week. I don't, there's really not much for me to add here other than to say that this is a prolonged period of time with that indicator. We know what's going on. We know there's a lot of options activity in and around the retail investor circuit, buying call options, betting on continued upside in individual names. That's obviously could be a big driver here. And it all plays out as the VIX just will not break 20, has not been below 20 since pre-COVID. And even as the market rallies, continues to hold the 20 level. Now, during that de-risking 2 weeks ago, we had the spike back up above 35, quickly reversed course and, taking things back down to the low 20s. But again, has not been able to break below that 20 mark. So an interesting dynamic when you look at the equity options, steadfastly in an excess greed position, while the VIX does not break 20. It's an interesting dynamic, but ultimately, they're data points, something to be aware of, but the trend remains, right? So we connect all the dots. These are just two data points within a mosaic. So we said we chat on home construction, and here it is. ITB, the iShares U.S. Home Construction ETF, very similar looking chart to that one of DHI, right? Solid rally coming out of the COVID lows and then into this consolidation. Now we've broken top side of the consolidation. ITB does have a very bullish ETF rating here at Chaikin Analytics. And take a look at Mo. The RSI has put in a series of higher lows that has shifted into a bullish regime for the indicator, closer to overbought here in the near term from an RSI perspective, as the fund trades above the rising 200-day moving average. On a relative basis, started to actually lag a bit in October, but we've now reversed ITB relative to the SPY at the bottom. Has reversed course, no new high yet, but the case can certainly be made that the downtrend from those October highs has been broken to the upside. So we'll see if the group can continue to build on that on an absolute and relative basis. And then finally, just some non-confirmation here, something to be aware of. That as equity markets have rallied higher, take a look at the SPY at the bottom of the chart, right? Trading at all-time highs, did not get a lower low on IEF, the iShares 7 to 10 year Treasury bond ETF. So that's something we want to be aware of. It's not a take action type of signal just yet, but if Treasuries do build from here and start to rally, and that rally looks like it's getting legs, I would expect to see some stalling activity and potentially some choppiness within the equity trend. So it's something that is on our radar now and that we'll be watching closely. That's going to wrap us up for today. Head over to chaikinanalytics.com/test drive. I'll be back here tomorrow.